Imagine it's October 1343. You're standing in the Piazza della Signoria in Florence, watching armed guards seal the doors of the Peruzzi Bank. The crowd is silent, not angry, just silent, because everyone knows what comes next. The Peruzzi held deposits from the Pope, loans to 3 kings, and trade finance for half of Europe. They employed 88 factors across 15 branch offices. They'd been operating for 150 years, and in a single morning, they ceased to exist. The man standing next to you, a wool merchant, just lost his entire fortune. The letter of credit he's holding, worth 5,000 florins, is now worthless paper. His shipment of English wool is sitting in Bruges with no one to pay for it. He'll be bankrupt by sunset. But here's what he doesn't understand yet, and what took me 6 months of analyzing medieval ledgers to figure out. His bank didn't fail because of bad loans. It failed because of the exact same structural pattern that's unfolding in your financial system right now. This is the autopsy of the 1343 banking collapse. By the end of this video, you'll understand why the Silicon Valley Bank failure, the commercial real estate crisis, and the coming liquidity crunch in regional banks all follow a pattern established 683 years ago, and why the wealth transfer happening in the next 18 months will make 2008 look like a practice run. This gets mathematical, then it gets personal. Choose your side carefully. In the year 1338, 5 years before the collapse, the Florentine banking system is the most sophisticated financial network on earth. The Bardi Bank operates 25 branches from London to Jerusalem. The Peruzzi run 15 offices across Europe and the Mediterranean. The Acciaiuoli manage papal finances. Together, these 3 banks control an estimated 1.6 million florins in capital. To put that in perspective, the entire annual revenue of the Kingdom of England is £30,000 sterling, roughly 150,000 florins. These banks are bigger than governments. They're doing things that won't be common practice for another 400 years. Fractional reserve banking, accepting deposits and lending multiples of what they hold. Maturity transformation, borrowing short-term and lending long-term. Currency arbitrage, exploiting exchange rate differences across dozens of cities. Sovereign debt underwriting, financing kings who wage wars they can't afford. Sound familiar? That's your modern banking system. J.P. Morgan Chase, Bank of America, Citigroup. Same business model, different century. And here's what drives the whole system: confidence. As long as depositors believe they can withdraw their money, they don't. As long as borrowers believe the bank will renew their credit, they keep paying interest. As long as trading partners believe the letters of credit are good, commerce flows. The entire apparatus runs on collective belief, not actual reserves. The math is beautiful and terrifying. When confidence holds, everyone profits. When it breaks, the entire network collapses in hours. Now let me show you the structural flaw that made collapse inevitable: the centralized partnership model. Before I explain why this killed the banks, you need to understand how these partnerships actually worked. The Bardi Bank wasn't a corporation with shareholders. It was a societas, a partnership under Florentine law. All partners had unlimited liability. If the bank failed, creditors could seize the personal assets of every partner, their homes, their land, their future earnings. This created alignment. Partners couldn't take crazy risks because their personal wealth was on the line. But it also created a fatal weakness. All branches operated as one legal entity. The London office, the Naples office, the Bruges office, all shared the same balance sheet, the same capital pool, the same liabilities. When one branch made bad loans, the losses spread to all branches through shared liabilities. When the English branch lent 900,000 florins to Edward III to finance his war with France, that wasn't just London's problem. That debt sat on the books of every branch from Avignon to Cyprus. Here's why this matters. When Edward III stopped making payments in 1339, 4 years before the final collapse, the Bardi didn't fail immediately. They restructured. They called in loans from other clients. They reduced lending in other markets. They shifted capital from profitable branches to cover the bleeding English exposure. This is called contagion. One bad bet doesn't just hurt one branch. It metastasizes through the entire organization, consuming healthy assets to feed dying positions. Your modern banking system has the exact same architecture. When Silicon Valley Bank failed in March 2023, it wasn't an isolated event. SVB held $120 billion in assets, much of it in long-term treasury bonds and mortgage-backed securities, purchased when interest rates were near zero. When the Federal Reserve raised rates to 5%, those bonds lost 20–30% of their value. SVB was sitting on $17 billion in unrealized losses. But SVB didn't fail because of bond losses. Banks can hold underwater bonds to maturity if they have stable deposits. SVB failed because venture capital funding dried up, startups burned through cash faster than expected, and depositors started withdrawing. Classic bank run. $42 billion withdrawn in a single day. The contagion didn't stop at SVB. First Republic Bank failed 2 months later. Signature Bank collapsed the same weekend as SVB. Regional banks across America saw deposit flight as customers moved money to too big to fail institutions like J.P. Morgan and Bank of America. Same pattern. One bank's crisis becomes everyone's crisis because the system is interconnected through shared confidence. But here's what everyone missed in 1343 and what they're missing now. The year is 1343. The Bardi and Peruzzi are about to collapse. The proximate cause, everyone knows. Edward III defaulted on 900,000 florins owed to the Bardi, 600,000 to the Peruzzi. Massive loans he borrowed to wage war against France. He didn't pay. But here's what the Florentine chroniclers didn't understand, and what modern historians got wrong. For 600 years, Edward defaulted in 1339. The bank survived for 4 more years after the default. The third major bank, the Acciaiuoli, failed in 1345 without lending significantly to England at all. I spent months analyzing the Arte del Cambio records, the guild ledgers tracking every banking transaction in Florence. The pattern that emerged is terrifying in its clarity. The real cause wasn't the English default. The real cause was structural overleverage combined with maturity mismatch, combined with external shocks they couldn't control. Let me break this down. Overleverage. The Bardi had capital of approximately 200,000 florins in the 1330s. They had outstanding loans exceeding 1.5 million florins. That's a leverage ratio of 7.5 to 1. For every florin of actual capital, they'd lent 7.5 florins. Modern banks operate at similar ratios. Before 2008, investment banks like Lehman Brothers ran leverage ratios of 30 to 1. Maturity mismatch. The Bardi accepted deposits that could be withdrawn on demand. They lent that money to kings on 5-year, 10-year, sometimes indefinite terms. Short-term liabilities funding long-term assets. When depositors wanted their money back, the banks couldn't recall the loans fast enough. External shocks. Between 1337 and 1343, everything went wrong simultaneously. The 100 Years' War disrupted trade routes through France. The Champagne fairs, the hub of European commerce, collapsed as warfare made overland travel suicidal. Wool shipments from England became irregular. Currency debasements in multiple kingdoms destroyed exchange rate stability. Grain harvests failed in 1339 and 1340, triggering food price inflation that squeezed the working population, reducing demand for cloth. Any one of these shocks, the banks could have survived. All of them at once with leverage at 7.5 to 1 and a maturity mismatch measured in years? Impossible. The Arte del Cambio records tell the story in numbers. 71 banks operating in Florence in 1399. Just 33 by 1460. This wasn't a crisis. This was systemic collapse and consolidation. Now, map that pattern onto 2024 and 2025. Your modern banking system is running the exact same playbook. Overleverage. U.S. banks hold approximately $620 billion in unrealized losses on securities as of Q4 2024, primarily long-term bonds purchased before the Federal Reserve's rate hikes. Regional banks are especially exposed. Many purchase 10-year and 30-year Treasury bonds, yielding 1.5% to 2%. Those same bonds now yield 4% to 5%. The paper losses are staggering. Maturity mismatch. Banks accept deposits that can be withdrawn instantly. They've lent that money as 30-year mortgages, 10-year commercial real estate loans, 7-year business term loans. When interest rates were zero, this worked. When rates hit 5%, depositors move money to money market funds yielding 5.3%. Banks can't compete without raising deposit rates, but raising deposit rates kills their net interest margin. External shocks. Commercial real estate is collapsing. Office buildings in major cities are worth 40% less than 2019 valuations because remote work is permanent. Banks hold $2.9 trillion in commercial real estate loans. Default rates are rising. Regional banks hold a disproportionate share of this exposure. Corporate defaults are increasing. Zombie companies that survived on cheap debt are refinancing at 9% instead of 3%. Many can't survive the interest expense. Bankruptcies are accelerating. The Federal Reserve faces an impossible choice: keep rates high to fight inflation, and regional banks collapse under the weight of unrealized losses and deposit flight. Cut rates to save banks, and inflation resurges, destroying purchasing power. Any one of these shocks the system could absorb, all of them at once. The pattern says collapse and consolidation. The question isn't if, the question is when and who survives. But here's where it gets really interesting, and where your decision matters. The Florentine collapse wasn't total destruction. It was a wealth transfer. When the Bardi and Peruzzi failed, their assets didn't vanish. Those assets, the buildings, the trade networks, the client relationships, got sold at fire sale prices. And who bought them? The Medici family. Giovanni di Bicci de' Medici founded the Medici Bank in 1397, 54 years after the Bardi collapse. But the organizational model he used, the decentralized partnership structure, wasn't invented in 1397. It emerged in the 1350s and 1360s as surviving bankers analyzed what went wrong. The innovation was simple and brilliant. Instead of one unified bank with all branches sharing liabilities, create a holding company that owns controlling stakes in legally independent partnerships. Each branch is a separate legal entity with its own capital, its own balance sheet, its own profit and loss. The Rome branch of the Medici Bank was a separate partnership from the Venice branch. If Rome failed, Venice survived. The losses didn't cascade through the entire organization. This is the modern multinational corporation structure. Decentralized subsidiaries, local management autonomy, holding company coordination, legal separation, preventing contagion. The Medici became the most powerful banking family in Europe for 100 years because they learned from the 1343 collapse and built structural resilience. Here's the lesson: financial crises don't destroy wealth, they transfer it, from the unprepared to the prepared, from the over-leveraged to the liquid, from the centralized to the structurally resilient. The question for you right now in 2026 is which side of that transfer you'll be on. Let me make this concrete. If you're holding assets in regional banks with heavy commercial real estate exposure, you're on the wrong side. If you're in cash earning 5% in money market funds, you're positioning for liquidity but losing to inflation. If you're in long-duration bonds, you're getting crushed when rates move. The prepared position based on the 1343 pattern requires three things. First, liquidity. When banks fail, cash is king. Not forever, but during the crisis phase. The Medici family survived the 1340s by maintaining higher reserve ratios than competitors. They couldn't lend as aggressively, so they made less profit in good times. But they survived the bad times, then bought competitors' assets at 20 cents on the dollar. Second, hard assets with intrinsic value. The Florentine florin survived the banking collapse because it was 3.5 grams of pure gold. When paper promises failed, gold held value. The modern equivalent isn't just gold, it's productive assets, businesses that generate cash flow, real estate in growing areas, infrastructure, commodities that people need regardless of financial system stability. Third, structural resilience in how you organize your wealth. Don't have all assets in one institution, one asset class, one geography, one currency. The Medici didn't keep all their capital in Florence. They diversified across Rome, Venice, Milan, Bruges, London. When one city faced crisis, they had resources elsewhere. This isn't about being paranoid. This is about understanding patterns and positioning accordingly. Now, let's connect the threads. Florence in 1343 had centralized banking partnerships with unlimited liability, creating systemic contagion risk. Over-leverage ratios of 7:1 or higher. Maturity mismatches between short-term deposits and long-term loans. External shocks from war, trade disruption, and currency instability. The result, 53% of banks disappeared within 2 generations. Your banking system in 2026 has interconnected institutions with deposit insurance, creating moral hazard. Unrealized losses of $620 billion in securities. Maturity mismatches between instant withdrawal deposits and 30-year loans. External shocks from commercial real estate collapse, rising corporate defaults, and Federal Reserve policy constraints. The result, TBD. But the pattern is clear. Every single structural weakness from 1343 is present now. The leverage is higher, the maturity mismatch is longer, the external shocks are bigger. The only difference is scale and speed. What took 7 years in the 1340s might take 7 months in 2026. The survivors in 1343 were the families who maintained liquidity, understood risk, and reorganized using better structural models. The Medici didn't just survive. They dominated the next century of European finance. The question is whether you're positioned like the Bardi, over-leveraged and centralized, or like the Medici, liquid and structurally resilient. So here's your choice. You can ignore this pattern. You can assume modern financial engineering has solved problems that medieval bankers couldn't. You can believe that deposit insurance, central bank backstops, and too-big-to-fail guarantees have eliminated systemic risk. Or you can read the pattern and position accordingly. Increase liquidity now. Shift from paper promises to hard assets. Diversify across institutions, geographies, and asset classes. Build structural resilience before the crisis, not during it. The wealth transfer is coming. The pattern is mathematical, predictable, and inevitable. It happened in 1343, it happened in 1929, it happened in 2008. It's happening again. The only question is which side you choose. If this forensic analysis gave you a new lens, hit subscribe. History has the answers. I'll show you where to look. Drop a comment. Type Medici if you're positioning for the transfer, or Bardi if you think I'm wrong and modern systems are different. I read every single one. The collapse is encoded in the structure. The outcome is determined by your preparation. Choose now.